Hi everybody, welcome to another update on the stock screener. Today we're going to look at a Rio2, a gold miner that's going in construction. It has crashed here 2 years ago because they didn't have the permits. Now it has retraced in half. So is there upside from here to back to 0.6? Let's see. I don't know. So how do we do this? We just compare it with our data that we had before. 70 million market cap now. 8 million ounces, so that's a lot. 8 million ounces, that should be worth 200 million. So this is actually cheap. But we also need to look, of course, at the cash flows. Capex was 111, now it's 117, so it's about the same. But this is important. The all-in sustaining cost was 1,000, and now it's up 25%. This has actually decreased the value of the project. Mine life is about the same. NPV 5% is now down. So from 380, it went down to 210 million NPV at 5% discount rate. I never use 5%, I use 10%. Okay, so we will see what happens when we use 10%. Production is about the same, 80,000 per year. Not bad, with expansion potential. I repeat, potential. But let's use conservatively 80,000. Yeah. So it was commissioning 2022. Now it's probably 2024. And there is some streaming, 6% going to 3.5% royalty. So we need to deduct that a bit. It's about 3% royalty if you take everything in account. So this is a valuation. There's a huge gap of 2 years because I didn't look at it. Share price went down. Valuation is the same. But this is the valuation in EBITDA. Okay, 5 times EBITDA valuation. Looks like there is upside, but when you check it a bit deeper, then you get the following chart. Yeah, it looks good, but the problem is when I calculate the cash flows, it's only 30 million cash flows per year. And we have a capex of 117. So it needs to be paid back. And then it still needs to rise to your enterprise value, which is 80 million. So I think this company is actually fair value. It is fair value. I don't see any upside. That's what it is. 3% royalty, production 91,000 for the first 15 years, and then we have first 12 years, and then for 5 years we have 54,000. Only sustaining cost 1,237, and we are going to plug in the battery. And we're back. So gold price 2,200. I have added some capex here, 15 million per year for 100,000 producer. I think that's reasonable. They said themselves that they do have some sustaining capital. So initial capital 117, and then Sustaining capital 88 million. But of course, they are also going to keep drilling and doing things, you know. So let's keep it at 15 million. Interest needs to be paid because they probably are going to use project capital. And that's about 70 million, I think, of the 100 million capex. So 10% interest on that is 7 million. They're going to pay it off a bit over the years. Tax rate, I think, should be around 35%. And that's it. This is the NPV flowchart for a 10% discount rate. They used a 5% discount rate. As you can see here, 5%. So let's see if I use 5%. If I use 5%, and here also 5%, then I get an NPV of 190 million, which is almost the same, 210 million after tax. So they use 5%, and then it could be, as you can see here, a double in valuation, because to go from here to here, you need to increase by 70 million, so that's a double. Okay. Yeah. This is a current enterprise value, needs to go to here. That's a double. But we don't use 5%. I always use 10% discount rate for all my miners. So I can buy other miners with a 10% discount rate. And Rio2 actually is fair value then, as you can see here, at 10% discount rate. So would I buy Rio2? No. You can see that the cash flows come in, but you are going to get your money back in 2037. And that's a long waiting time. I don't want to wait that long. There are other companies that I like more. Yes. Let's say this capex, let's say this capex goes to 10 million, just to see what happens. Then maybe there's a little bit of upside, 20%. 20% upside. That's not a lot. You need to understand it's not built yet, and there could be some problems along the way. It's also not financed yet. The grades could be lower than expected. The capex could be higher than expected. So uncertainty still exists. It's not built yet, still 2 years. And it's already fair value, as you can see here on this chart. So this is a no-go for me. Let's actually see what happens when we go to 2,500 gold. See what the leverage is. Upside is 3x. 2 to 2.5x. When gold goes up 20%. 20% gives you a 2x increase. Up 100%, 200%, That's a lot of leverage actually. There is a lot of leverage because a 20% increase in the gold price gives you a plus 150%, 7 times leverage. So yeah, if you want a leverage play, this is actually a good one. Very leveraged to the gold price. But at the current gold price of 2,100, 2,200, this is fair value. Yeah, so that was our assessment of Rio2. People think this could go back to 0.6 and double. I don't think so yet. I think this is fair value. If the gold price rises, then I agree it could have some upside. But the thing is, it's not built yet, okay? So yeah, do with this what you want. I'm not buying it. I'll see you in the next video. Bye.